Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Swire Pacific Limited Annual Report. Swire Pacific Limited is a diversified conglomerate with various business divisions that cater to different industries. At its core, the company's property division focuses on developing and managing mixed-use properties, including office towers, shopping malls, hotels, retail space, residential projects, and serviced apartments. In addition to property development, Swire Pacific also has a significant presence in the aviation industry through its aviation division. This division provides essential services such as flight catering, passenger handling, ramp handling, aircraft maintenance, and modification. The company also owns and operates a cargo terminal at Hong Kong International Airport. The beverages division is another key area of focus for Swire Pacific, with rights to manufacture, market, and distribute beverages to consumers. This division plays a crucial role in the company's overall business strategy. Swire Pacific's trading and industrial division is perhaps its most diverse segment, encompassing various industries such as retail, automotive, food, and waste management. The company markets, retails, and distributes footwear, apparel, and accessories through its retail outlets, sells passenger cars, commercial vehicles, motorcycles, and scooters, operates a chain of bakeries, packages and sells sugar products under the Teku Sugar brand, and offers waste management services. Overall, Swire Pacific Limited's business portfolio is extensive and diverse, with operations spanning multiple industries and geographies. Swire Pacific Limited market capitalization of $311 billion is significantly larger than the average industry peer of roughly $19 billion. This shows that Swire Pacific Limited holds a significant advantage in their industry. Swire Pacific Limited trades at a higher price-to-earnings ratio of 40 times and a higher price-to-book ratio of 0.45 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 4.43%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company can be attributed to several key factors across various segments. In terms of revenue growth, the aviation segment is driven by increases in passenger and cargo revenue, while the beverages segment experiences growth from sales of beverage drinks, goods, services, aircraft maintenance, and property rentals. The property development segment also contributes to revenue growth through completed properties for sale in Hong Kong. Associated companies, such as HAECO ITM Limited and Shanghai Teku Aircraft Engineering Services Company Limited, also contribute to revenue growth. On the other hand, revenue decline is driven by decreases in total operating expenses of Cathay Pacific Airways in the aviation segment, and a decrease in revenue from the trading and industrial segment. The property development segment does not have any specific drivers of revenue decline. The company's revenue growth rates vary across segments, with some experiencing significant increases while others experience declines. Operating expenses have increased over time, contributing to a decline in operating profit before non-recurring items. Non-recurring items, such as changes in fair values of investment properties and capital expenditure in response to climate change, also impact revenue growth or decline. The net income of the company has shown an improvement, transitioning from a loss to a reduced loss. In 2025, it increased by $1,537 million, representing a 64% growth compared to the previous year. This positive change can be attributed to various factors. One significant reason for this improvement is the enhanced e-commerce capabilities and new channels at Swire Coca-Cola. The company's focus on prioritizing sparkling, revenue growth and cost efficiency initiatives has also contributed to its increased net income. Additionally, improved consumer spending in the Chinese mainland and growing demand for base maintenance and engine services at HAECO have positively impacted the company's financial performance. In terms of profit margins, there is a mixed trend observed across different regions. The Swire Coca-Cola Hong Kong and Chinese mainland segment has seen an increase in profit margin by 0.55%, while the Swire Coca-Cola Vietnam and Cambodia segment has experienced a decrease of 1.2%. However, the Swire Coca-Cola Thailand and Laos segment has shown a significant improvement with a 9.3% increase in profit margin. The introduction of a simpler regional management structure and the appointment of a chief operating officer have also played a crucial role in driving these changes. Overall, the company's efforts to enhance its operational efficiency and adapt to changing market conditions have contributed to its improved financial performance. The company's financial performance in 2025 indicates a positive trend in its operating cash flow. According to the provided information, the cash generated from operations for the year 2025 is HK $17,020, which is a significant indicator of the company's ability to generate sufficient funds from its core business activities. This positive operating cash flow suggests that the company has been able to manage its expenses effectively and has been generating enough revenue to cover its operational costs. As a result, the company is likely to have a stable financial position, enabling it to invest in growth opportunities, pay off debts, or return value to shareholders. Overall, the company's positive operating cash flow in 2025 is a reassuring sign of its financial health and resilience. The company's debt level has undergone significant fluctuations over the past year. Initially, net borrowings decreased by HK $5,299 million on page 83. However, this trend was short-lived as total debt increased to $93,562 million at the end of 2025, up from HK $74,297 million in 2024. Despite this increase, long-term loans and bonds saw a decrease to HK $71,572 million in 2025 compared to HK $76,118 million in 2024. A more comprehensive look at the debt level reveals that it actually decreased by HK $721 million, 0.54%, from HK $133,215 million in 2024 to HK $132,494 million in 2025. Furthermore, total borrowings increased to HK $22,244 million in 2025 compared to HK $16,433 million in 2024. Loans and bonds also saw a decrease of HK $3,155 million from H $91,591 million at the beginning of 2025 to HK $8,436 million by the end of the year. In terms of interest expenses, there is conflicting information across different pages. However, it can be inferred that interest expenses have generally decreased over the past year. On page 150, interest expenses were reported to have decreased by HK $148 from HK $3,461 in 2024 to HK $3,609 in 2025. Similarly, on page 155, interest expenses were reported to have decreased by H $989 million, 1.01%, from H $97,900 million in 2024 to H $96,911 million in 2025. However, there are instances where interest expenses have increased. On page 208, interest expense was reported to have increased from HK $147 million to HK $157 million. Nevertheless, on pages 184 and 150, interest expenses were reported to have decreased by HK $20 million and HK $148 respectively. The company's performance varied across different segments and regions. On the positive side, Swire Coca-Cola experienced a 253% increase in revenue and 251% increase in sales volume. Hong Kong also performed well, with a 2% increase in revenue and 9% increase in gross profit per unit case. Taiwan saw a 14% increase in revenue and 13% increase in sales volume. In terms of operating profits, the property segment generated HK $6,939 million, while Beverages Chinese mainland contributed HK $146 million. The aviation sector also performed well, with Cathay Group generating HK $4,449 million in operating profit and HAECO Group contributing HK $1,510 million. However, some segments and regions struggled. Cambodia and Laos saw a decline of 11% in revenue and 7% decrease in sales volume. Thailand's EBITDA margin decreased from 12.6% to 11.7%, while its EBIT margin dropped from 6.7% to 5.6%. The property segment incurred an operating loss of HK $586 million, while the beverages sector faced significant losses in various regions, including Hong Kong, Taiwan, Vietnam and Cambodia, and Thailand and Laos. The aviation sector also experienced losses, with others generating an operating loss of HK $427 million. Trading and industrial segments, such as Taeku Motors and Swire Environmental Services, reported operating profits but were offset by significant losses in other areas. Overall, the company's performance was mixed, with some segments and regions performing well while others struggled. Management's outlook and strategy. A focus on sustainable growth. The company's management has outlined a clear vision for sustainable growth through strategic investments in core divisions across Greater China and Southeast Asia. This includes targeting new areas such as healthcare, where significant opportunities are expected to emerge. To achieve this goal, the company will prioritize dividend policy, focusing on delivering sound returns on equity over the long term. A key aspect of management's strategy is the acceleration of decision-making at Swire Coca-Cola, with a new management structure in place to drive sustained growth. Additionally, efforts will be made to improve production and logistics efficiency, commercial capability, and cost efficiency across various businesses. The company also expects gradual improvement in demand for various sectors, including high-quality residential developments, and plans to double its gross floor area in the Chinese mainland. Furthermore, management aims to maintain a leadership position in cardiac surgery while broadening cardiology services at Delta Health. In line with its commitment to sustainability, the company will prioritize investments that support climate transition coordination and capital allocation. Employee well-being and occupational health and safety are also key priorities for management, who is committed to maintaining a safe working environment for all stakeholders. Overall, management strategy is centered around sustainable growth through strategic investments in core divisions, improvement of operational efficiency, and prioritization of sustainability direction and employee well-being. Acquisitions and divestitures are crucial components of a company's growth strategy. In this context, acquisitions refer to the purchase or acquisition of new businesses, assets, or interests by the company. The company has made several notable acquisitions in recent years. One significant acquisition was Phase 3 of Taeku Hui, which was acquired in August 2024. Additionally, the company invested in Empire City in 2021 and acquired a 40% interest in a site on Wireless Road in Bangkok in February 2023. The company has also expanded its presence in the beverages industry through subsidiary interests in Cambodia, Vietnam, Thailand, and Laos between 2022-2024. Furthermore, it acquired several subsidiary companies for HK $78 million. On the other hand, divestitures refer to the sale or disposal of non-core businesses, assets, or interests by the company. The company has made significant divestitures in recent years, including the sale of car parking spaces at Taeku Xiing and a non-core site in Xingye. It also exited its investment properties portfolio in Miami and sold 2 ultra-luxury houses. The company has continued to divest its interests in various businesses, including HAECO Americas, the HAECO ITM inventory management business, and the North Squared site in Brickell, Miami. In 2023, it disposed of SCCU, while in 2025, it sold its interests in certain investment properties in the USA to Simon Property Group and disposed of certain fixed assets of Swire Coca-Cola. The company's financial activities have been multifaceted. One notable aspect is its commitment to returning value to shareholders through dividends. The company has a history of paying dividends, as evident from multiple references throughout the document. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares on the market. Concerns about inventory buildup and supply chain disruption exist in certain regions. In China, traditional distribution channels have been disrupted due to increased competition and weak consumer sentiment in neighboring countries such as Vietnam and Thailand. However, companies appear to be taking proactive measures to mitigate these risks. Supplier diversification strategies, strategic inventory maintenance, contracts for price volatility, and robust supplier continuity plans are being implemented to manage responses to urgent scenarios. Additionally, there has been an increase in goods for sale, manufacturing materials, and production and service supplies from 2024 to 2025, which may indicate a growing demand. However, the registered capital of various companies indicates potential supply chain disruption risks. Despite these concerns, the overall report does not highlight any major inventory buildup or supply chain disruption issues. That concludes the financial summary for Swire Pacific Limited. Feel free to comment below, and I will be happy to answer them when possible.